Hello, this is Japanese Economic Review Channel. Today, we'll analyze Japan's June 2026 trade statistics. We'll explore how a historic weak yen, at $159.69 to the dollar, artificially inflates nominal values, driving both record exports and a persistent deficit fueled by heavy energy import burdens. Let's look at the top-line figures. Exports grew for the 10th consecutive month by 19.3% to $10.93 trillion. However, imports surged 25.4% to $11.34 trillion, resulting in a $406.9 billion deficit. The driving force is a 10.9% year-over-year yen depreciation. This slide reveals a critical structural issue. Despite the impressive 19.3% nominal export growth, the actual export volume index only rose by 0.2%. Similarly, import volume only grew 1.1%. The trade deficit is locked in by inflated costs, not higher physical consumption. The exchange rate is our primary distortion field. The yen's drop amplifies the nominal value of our auto and tech exports. However, it acts as an immense import cost penalty by multiplying the financial burden of crude oil and resource imports, widening the real deficit gap. What fuels our export engine? It is highly concentrated. Automobiles grew 23.0%. Semiconductors and electronic parts surged 53.8%, and non-ferrous metals rose 47.8%. This demonstrates our strong industrial competitiveness, particularly in global high-tech supply chains. Conversely, our $11.34 trillion import burden is dominated by energy and tech components. Crude oil imports skyrocketed by 59.3%. Combined with high-volume tech imports, the weak yen creates an expensive structural floor for our total import values. Looking globally, our trade dynamics vary by region. We maintain surpluses of $339.7 billion with the US and $244.0 billion with Asia. However, we face deficits of $157.9 billion with the EU and a massive $820.2 billion with China. Let's break down these regional shifts. Our U.S. trade surplus shrank by 49.0%, the seventh consecutive month of decline. While auto exports remain robust, an astounding 907.4% surge in crude oil imports from the U.S. completely offset these gains. This energy burden is effectively erasing our manufacturing profits. A similar paradox appears in the EU. Despite a 192.0% jump in semiconductor manufacturing equipment exports, Japan slipped into a 157.9 billion yen deficit. This was triggered by an 899.0% explosion in petroleum product imports, neutralizing our strong export performance. In Asia, trade reflects an integrated tech supply chain. Semiconductors and electronic parts drive over 50% growth in both directions. Exports at plus 57.7% and imports at plus 52.4%. This is not simple consumer trade, but a highly codependent manufacturing ecosystem. With China, Japan faces an entrenched $820.2 billion deficit, marking 63 consecutive months in the red. While exports of semiconductor parts are up 77.5%, massive import volumes lock Japan into an unfavorable structural balance, despite growing bilateral trade flows. Japan sits at the fulcrum of the global semiconductor cycle. Global tech demand immediately spikes our imports of raw materials from Asia. We then process these and export advanced equipment and parts globally. This cyclical flow dictates Japan's overall trade volumes. Analyzing the 13-month trajectory, we see the deficit gap widening globally. The sharp decline in our U.S. surplus, alongside rapidly expanding nominal volumes in Asia, underscores how quickly import costs, accelerated by currency weakness, are outpacing our export growth capacity. Historically, we are witnessing unprecedented capital movement. Both exports and imports reached their highest recorded values for the month of June since 1979. The economy isn't slowing, it's experiencing heavily amplified cross-border transactions driven by the exchange rate. To conclude, first, Japan's manufacturing engine remains hot. Second, a structurally weak yen and foreign energy dependency act as an unbreakable ceiling on surpluses. Third, our tech supply chain is highly circular. Japan remains a powerhouse, but paying a premium to fuel its engine. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.